In 1770, one man discovered something. He figured out that if you said the right things, you could print money. His name was John Law. He had no guns, no army, no power to force anyone to do anything. All he had was a mouth and a story that sounded airtight. Let me help France turn its debt into wealth. The French government said yes. Within 2 years, ordinary Parisians were camping outside John Law's office just to get their hands on a subscription form before the next round of fundraising. People sold their homes, jewelry, and family silverware for shares in his company. Paper wealth exploded 3,600% in 18 months. Then, it all vanished. Not slowly, overnight. The French middle class, the people who trusted the system, played by the rules, and dutifully put their savings in, were wiped out. And John Law, he slipped away to Venice and lived out the rest of his days in quiet comfort. The bankers and government officials who designed and drove the whole thing, essentially nobody faced consequences. They waited a few years, then started designing the next scheme. The system repeats. My name's Toomey, and I've spent way too much time thinking about why every generation falls into the same trap all over again. If you've noticed that conventional investment advice sounds perfectly reasonable but seems to stop working exactly when you need it most, then what comes next was written for you. Because John Law's story isn't a history lesson, it is playing out right now inside your retirement account. The only difference is that this time, the worthless Louisiana swampland has been replaced by 7 tech companies. Let's talk about what you think diversification actually means. Imagine you are building a house. The contractor tells you, "Don't you worry, we used 500 support beams." Sounds solid, right? Then you walk inside and discover that the entire foundation, every load-bearing wall, is resting on 7 of those beams. The other 493 are basically decorative. The contractor says, but these 7 beams are incredible. They've been reinforced every year for the past 15 years. Would you live in that house? Would you raise your kids there? Because that is your S&P 500 index fund. As of early 2026, this 500 company index has more than 30% of its total market cap concentrated in just 7 stocks: Apple, Microsoft, Nvidia, Amazon, Alphabet, Meta, and Tesla. 7 companies out of 500. Back in the 1990s, those same 7 companies represented roughly 15% of the index. 25 years, concentration doubled. Every financial advisor is still telling you, buy and hold index funds. It is the safest approach. Nobody explains what happened to concentration over those 25 years. Here is where it actually gets important. In 1972, there was a group of stocks that institutional investors treated as holdings they never need to sell. They called it the Nifty 50, America's 50 finest blue chips: Polaroid, Xerox, Kodak, Avon, Sears. Everyone said, these companies are too important to American life to ever fail. Growth is guaranteed. Even at 60 times or 80 times earnings, it doesn't matter. The growth will eventually justify it. Then, the oil crisis hit in 1973. Polaroid fell 91% from its peak. Avon dropped 86%. Xerox dropped 71%. These weren't risky startups. These were the safest investments in America at the time. If you bought at the 1972 peak and held on, not accounting for inflation, you needed a full 25 years just to break even. A quarter century, zero return. Meanwhile, the executives who sold near the top, the investment banks that underwrote those stocks, the insiders who got out early, they made a killing. The ordinary investors who bought at the highs on the strength of safe advice, the retirees who thought they were being conservative, the pension funds that needed steady returns, they were on the losers list. Now, it is 2026, and the pattern is back. The pattern repeats every cycle. Nvidia is a genuinely remarkable company with genuinely revolutionary technology. In 2023, its market cap was $300 billion. By early 2026, it crossed $3 trillion, under 3 years, 10 times the price. Did their revenue grow? Yes. Did it grow 10 times? No. What actually grew 10 times was the multiple investors were willing to pay. Structurally, this is the exact same story as Polaroid in 1972. If Nvidia drops 50% from here, not some crazy hypothetical, every high-growth tech stock in history has seen corrections like this. That one stock alone would drag the S&P 500 down nearly 5%. If Apple, Microsoft, and Alphabet see similar drawdowns simultaneously, even if the other 493 companies hold up just fine, the S&P 500 as a whole could fall 20 to 30%. And you thought you were diversified. This is the most elegant part of the whole setup. It makes you feel safe. They call it diversification. 500 companies sounds spread out. But when 7 companies hold a third of your money, you are not diversified, you are concentrated. They use market cap weighting, a term that sounds rigorous and professional. What it actually means is, the stocks that have already gone up the most automatically get more of your money. You are systematically buying more of the most expensive stocks and less of the cheaper ones. Which is the exact opposite of what every successful investor actually does. They show you the long-term charts that smooth out every crash. Yes, markets eventually recover, but eventually sometimes means 25 years. Do you have 25 years to wait? Say you have $500,000 in a standard S&P 500 index fund. Roughly $150,000 of that is effectively concentrated in those 7 stocks. If those 7 stocks drop 50%, the way the Nifty 50 did, the way tech stocks did in 2000, you lose $75,000 on that portion alone. Now say you moved $75,000 of that $150,000 into equal weight funds, international markets, or small cap value stocks 6 months earlier. Those assets might also fall, but because their valuations aren't stretched nearly as far, they likely drop around 20%. Say money loss becomes $15,000 instead of $75,000. Just by being aware of concentration risk, you potentially saved yourself $60,000. I know what you are thinking. What if those 7 stocks keep going up? What if Nvidia hits $5 trillion and I missed it? That is a fair question. But it is not the right question. The right question is, what is your actual goal? Are you trying to maximize short-term gains if the current trend continues? Or are you trying to build real wealth that survives across different market environments? Nobody can tell you when the music stops. John Law's Mississippi Company looked like a sure thing until the day it wasn't. The Nifty 50 seemed unstoppable until it stopped. Japan's stock market was the largest in the world in 1989. The Nikkei hit an all-time high of 38,915. Everyone was saying Japan would overtake America. As of 2026, 37 years later, it has barely clawed its way back to that peak. 37 years, 0 return. This isn't a prediction that the US market will replay Japan's story. Maybe it won't. But if your retirement plan is built on the assumption that these 7 stocks can all fail at the same time, you are not investing. You're not investing, you're gambling. So if I were rebuilding my portfolio from scratch in 2026, what would I actually do? Not theory, not strategies that worked in 2010. Real, sensible action given today as market structure. Step 1. Do this tonight. Find out your actual concentration. Open your accounts, pull up your index fund, look at the top 10 holdings. Add up those percentages. If they exceed 25%, you are not diversified, you are concentrated. Most people have never done this step. They assume index fund equals safe. It doesn't. Step 2. Implement a reverse concentration strategy. You don't have to sell everything. You don't have to bet on individual stocks. You just need to manually rebalance the risk. Equal weight index funds, 500 companies, each with the same weight. So number 7, stocks automatically eat a third of your money. International developed markets, Europe, Japan, Australia, currently at 15-year valuation, lows relative to US stocks. Small cap value stocks, historical data over the past 20 years shows this category outperforms large cap growth over the long run, but has been left in the dust for the past decade, which means it is now an attractive value proposition. If a standard index has 30% of your money sitting in mega cap tech, you can put 30% of your portfolio into assets that are uncorrelated with tech. Emerging markets, commodities, REITs holding physical assets. Tips. This isn't timing the market. This isn't guessing where the top is. It is manually rebalancing concentration risk that has been passively building up. Step 3. Set valuation trigger rules. Let rules make decisions instead of emotions. If any single stock in my portfolio exceeds 8% of total account value, automatically trim it back to 8%. If the S&P 500 PB ratio exceeds 30, automatically shift 10% of equity exposure into bonds or cash. If my index fund's top 10 holdings exceed 30% of my total assets, do an equal weight rebalance. This isn't active trading. This is valuation discipline. Every successful endowment fund and sovereign wealth fund operates this way, but retail investors are told to just buy and hold and never ask questions. Yale's endowment fund, widely considered one of the best managed pools of capital in the world, allocates less than 10% to US equities. 10%. Not because they don't believe in American markets, because they understand that any single bet, no matter how certain it seems, should have a structural ceiling. Step 4. Build income protection outside your portfolio. People panic sell at market bottoms, not because they don't understand investing, it is because they desperately need the cash. The market is in freefall, and they have no other option. If you have 12 months of living expenses sitting in a high-yield savings account, you've acquired the most valuable thing in investing, optionality. In 2008, people with cash on hand bought stocks at 50 cents on the dollar. People without cash sold stocks at 50 cents on the dollar to cover their mortgage. Same crisis, completely opposite outcomes. The only difference was whether or not they had that buffer. Desperation makes you sell at the bottom. That is exactly how wealth transfers from ordinary people to institutions. The sequence of returns matters just as much as the average return. Two people with the exact same 20-year average annual return. If one of them hits a 50% crash in year 10, just before retirement, they'll run out of money. The other person hits the same crash early in their career and comes out fine. If you are 15 years from retirement, you don't have 25 years to recover from a crash. A 25% loss at 55 and a 25% loss at 30 are not the same thing. At 30, you have time, you have income, you can rebuild. At 55, you may not get a second shot. If I were building a portfolio from scratch in 2026, it would look roughly like this. 30% diversified US. Equities equal weight or tilted towards small cap value, 20% international developed markets, 10% emerging markets, 15% real assets, REITs, commodities, infrastructure funds, 15% bonds, treasuries plus corporate, 10% cash and short-term equivalents. No single piece of this is a bet on one specific version of the future. If tech collapses, you're not destroyed. If inflation spikes, you have protection. If rates rise, your cash can be redeployed. You're not predicting the future. You're building resilience against uncertainty, not trying to predict what comes next. You're making sure you can survive multiple versions of it. Late 2027, some kind of shock hits. Doesn't matter if it is a recession, a geopolitical crisis, or a tech regulatory crackdown. Major tech stocks fall 40% over 6 months. The S&P 500 overall drops 28%. His portfolio goes from $900,000 to $650,000. Angry and terrified, he sells half his remaining position for cash, locking in the losses. The market gradually recovers over the next 3 years, but he is mostly sitting in cash and misses most of the rebound. You rebalanced a year earlier, equal weight, international exposure, bonds, cash buffer. Your portfolio drops 20%, not 28%. You don't need this money for 5 years, and you have a year's worth of cash reserves, so you don't have to sell a single share. In fact, you're able to buy more at the bottom. 3 years later, when the market recovers, your portfolio is higher than it was before the crash. Same market, completely different outcome. The only difference, you were prepared. Most people treat their portfolio like a houseplant. Water it regularly, give it some sunlight, check on it once a year, and pray it doesn't die. That approach worked brilliantly from 1980 to 2000 and again from 2009 to 2021. Because during those periods there was a massive structural tailwind, continuously falling interest rates and expanding valuation multiples. That tailwind is gone. The old rules no longer apply. You must adapt or be left behind. Rates are higher and unlikely to return to zero. Valuations are already at historical highs. You can't just plant your money and walk away anymore. You have to treat your portfolio like a garden. It still needs investment, it still needs watering. But it also needs weeding, pruning, and crop rotation, adjusting to the seasons. Not watching it every day, not overreacting to every headline. But doing a quarterly review, checking valuations, trimming what is run too hot, adding to what is being beaten down. Not watching it every day, but doing a quarterly review, checking valuations, trimming what is run too hot, adding to what is being beaten down. Because when the next crash comes, and it will come, it always comes, you need to know you've already done what needed to be done. If you just bought a plain index fund and hoped for the best, when it drops 30% or 40%, you'll feel like a victim. You'll panic, you'll sell at the bottom. You might swear you'll never touch stocks again, but if you've already reduced concentration, built income protection, and genuinely diversified, you won't be happy about the losses, but you won't be broken by them. You'll ride it out, you might even buy more. That is the only real difference between the people who accumulate wealth through market cycles and the people who get wrecked by them every single time. The financial industry spent 40 years convincing you of two contradictory things. 1. Investing is complicated and you need expert guidance. 2. Just buy index funds and don't think about it. Both of these cannot be true at the same time, and they're sold simultaneously because both benefit the financial industry. Complicated products charge high fees, while passive index funds keep your money sitting in accounts they manage forever. Just like John Law convinced the French that paper currency, with no physical backing, was equivalent to gold. The financial industry has convinced you that a fund with 30% of its money concentrated in 7 stocks equals true diversification. It doesn't. It is a concentrated bet that a small number of companies will continue to dominate indefinitely, and historically, every period of extreme concentration has ended with a sharp correction. I am not saying these 7 companies are going to crash tomorrow. I genuinely don't know. Nobody else does either. Nvidia might be worth $10 trillion in 5 years, or $1 trillion. What I am saying is, if you don't know this concentration exists, if you are not actively managing that risk, you are repeating the exact same mistake as the people who invested in the Mississippi Company and the Nifty 50. They weren't stupid, they were smart, hardworking, and playing by the rules. They just assumed that what had worked before would keep working forever. And nobody, not a single person, told them in advance that the structure had changed. Wealth isn't built by swinging for home runs. The real secret is, don't get knocked out of the game. If you can earn solid 7 to 9% annual returns while avoiding the catastrophic losses, 30 years from now, you'll be in the top 10% of investors. The people chasing 15% annual returns are often the same people who take the biggest hits when the market turns. The people chasing 15% annual returns are often the same people who take the biggest hits when the market turns. Not losing sometimes matters more than earning more. But the only way to hold on when real pressure arrives is to be prepared. So you're never forced to sell at the bottom. So tonight, open your portfolio. Look at the top 10 holdings. Do the math on your concentration. Check whether what you think is safe is actually safe. The answer might make you uncomfortable. But uncomfortable now is a lot better than discovering the truth 25 years too late. You're not like most people. Most people wouldn't have read this far. Now you know. The question is what you're going to do about it.